Level 1. Budgeting at $15,000 a year, when survival is the only strategy. You take home $1,250 a month. You work part-time, maybe retail, maybe food service, maybe an entry-level office job while finishing a degree or waiting for something better to open up. Your rent is $600, split with a roommate because solo living is not even a conversation at this number. Phone bill, $55. Bus pass, $65. Groceries, $220. That is $940 gone before you buy a single personal item, pay a single medical copay, or cover a single unexpected expense. You have $310 left for everything else. There is no budgeting method on earth that fixes $310 of monthly margin. Not the envelope system. Not zero-based budgeting. Not a color-coded spreadsheet. The math is broken before the method even starts. The one mistake people at this level consistently make is treating it as a spending problem when it is entirely an income problem. Cutting $30 from groceries does not change the trajectory. Finding 8 hours of freelance work a month at $15 an hour adds $120 to the margin and changes the entire equation. What actually works here is ruthless prioritization combined with aggressive income hunting. Keep fixed costs as low as physically possible. Eat at home. Use every free resource available. Treat every extra dollar of income as the emergency fund contribution that the budget simply cannot generate on its own. The goal at this level is not financial growth, it is financial stability. Getting to $1,000 in savings without going into debt is the entire win. Everything else comes after that. Level 2. Budgeting at $28,000 a year. When the math almost works but never quite does, you take home $2,100 a month. Rent, $850. Phone, $65. Groceries, $280. Transportation, $120. Utilities, $85. That is $1,400 in fixed costs. You have $700 remaining. Out of that $700, you cover clothing, personal care, medical copays, and the minimum payment on a credit card balance you built up covering gaps between paychecks. Some months the $700 holds. Most months something unexpected, a $180 car repair, a $95 prescription, one slow week at work, pushes you back to the card. Here is the specific problem at this level that nobody addresses honestly. The margin exists, but it is fragile. One unexpected expense does not just hurt the month. It undoes 3 months of progress because the credit card balance goes back up and the minimum payment next month is slightly higher than it was before. The 50-30 rule says spend 50% on needs. At this income, your needs consume 67% before you try to do anything right. Telling you to save 20% is not advice. It is an insult to your arithmetic. What works here is a micro emergency fund first. Not a full 3 to 6 months. Just $500 sitting in a separate account that exists for the sole purpose of making sure the credit card never gets touched again. That single buffer breaks the cycle that has been keeping your balance alive for months. After the buffer, every extra dollar above minimums attacks the credit card. At $6,000 and 22% interest, you are paying over $100 a month just in interest. Killing that debt returns that $100 to your budget permanently. That is the raise you cannot get from your employer but can give yourself. Level 3. Budgeting at $45,000 a year. When you have room but it keeps disappearing, you take home $3,200 a month. Rent, $1,050 for a one-bedroom. Car insurance, $148. Student loan minimum, $214. Subscriptions you think are $3 but are actually $7, $94. Groceries, $310. Gas, $140. Phone, $85. That is $2,041 in fixed costs. You have $1,159 left. That $1,159 sounds like breathing room. It is not. Eating out across the month runs $380. Clothing and personal items, $160. Random online purchases you do not register as spending but that show up every single month on your statement, $130. One weekend trip every couple of months averaged monthly, $85. Miscellaneous, the category no budgeting app ever fully captures, $170. That is another $925 gone. You end most months with $200 to $300 more than you started with, and a persistent feeling that you should be further ahead than you are. The problem at this level is not overspending. It is unassigned margin. The $1,159 sits in your checking account, where it is invisible and available, and it gets absorbed by the current of daily life without a single dramatic purchase to blame. What works here is automation before visibility. The day you get paid, money moves without you making a decision. $150 to emergency fund, $150 to Roth IRA, $100 extra on the student loan. What remains in checking is your life budget. You cannot spend the money you never see. The student loan at minimum payments costs you thousands in interest over the remaining years. Adding $100 a month above the minimum cuts years off the timeline and saves you thousands you keep instead of handing to a lender. Level 4. Budgeting at $65,000 a year. When comfort arrives before the plan does, you take home $4,400 a month, rent $1,280 for a one-bedroom in a decent part of the city, car payment $310, insurance $175, groceries $360, utilities $145, phone $90, gym $55, streaming and subscriptions $87. That is $2,502 in fixed costs. You have $1,898 left. This is the income level where the budget problem quietly changes character. The margin is real. The needs are covered. And for the first time, there is enough money coming in that spending feels genuinely deserved. You work hard. You earn $65,000. You should be able to eat at a good restaurant without calculating whether you can afford it. That feeling is not wrong. It is just expensive when it runs without a boundary. Dining out, $420 a month. Clothing, $190. Personal care, $130. Online shopping, $160. Weekend activities, $140. That is $1,040 in discretionary spending that feels controlled, but adds up to $12,480 a year. After all of that, you are saving roughly $400 to $500 a month. Contributing 4% to your 401k, you have about $9,000 saved. What works here is the clarity audit, not a restriction budget, a full picture of where every dollar goes, written down once, looked at honestly. Because you do not have a discipline problem, you have a visibility problem. When you see that $160 in monthly online purchases is $1,920 a year, and compare that against what $1,920 invested at 10% becomes in 20 years, which is just over $12,800, the decision changes. Not because you are forced to change it, because you finally have the information to make it consciously. Level 5. Budgeting at $95,000 a year. When the income is strong but the structure is weak, you take home $6,400 a month. Mortgage, $1,720. Property tax average monthly, $380. 2 car payments, $610 combined. Groceries for a family of 3, $640. Utilities, $230. Insurance across health, home, and auto, $520. Kids activities, $280. Phone plans for 2, $145. Subscriptions, $112. That is $4,637 in fixed and semi-fixed costs. You have $1,763 left. You contribute 6% to your 401k because that is the company match, and stopping at the match felt responsible when you set it up. You have $67,000 in retirement savings, no brokerage account, $4,200 in savings, and a quiet, uncomfortable awareness that the numbers should look better than this by now. The problem at this level is the mismatch between income and financial progress. You earn $95,000 a year. The gap is not lifestyle, it is structure. Two car payments costing $7,320 a year. A savings rate sitting at 6% when it should be climbing toward 20%. An emergency fund that covers less than 1 month of expenses. What works here is a structural reset built around a predetermined sequence. Car number 1 gets paid off. That payment immediately rolls into the emergency fund until it reaches 3 months of expenses. Then it rolls into the brokerage account. The sequence is decided in advance, so there is no decision to make in the moment and no willpower required. You do not have a spending problem, you have a sequencing problem. The money is there. It just has not been given a clear order of operations. Level 6. Budgeting at $140,000 a year. When high income meets invisible complexity. You take home $9,100 a month. Mortgage, $2,450. One car payment remaining, $445. Private school tuition, $1,600 a month. A decision made years ago that felt manageable and now feels permanent. Groceries, $720. Utilities, $310. Insurance across all categories, $680. Housekeeper twice a month, $240. Subscriptions and memberships, $195. Phone plans for the family, $210. That is $6,850 in fixed costs. You have $2,250 left. You max your 401k at $1,917 a month. That leaves $333. You earn $140,000 a year and have $333 a month of personal surplus before a second income or a bonus fills the gap. Every individual expense is justifiable. The school is good. The housekeeper saves 12 hours a month. The insurance is appropriate. But the collective weight of years of incremental lifestyle decisions has built a machine that requires everything running at full capacity to operate without stress. What works here is the annual financial audit. Every recurring expense examined once a year with one question. If you were setting this up today, knowing what you know now, would you choose this? Some answers will be yes. Some will be no. The ones that are no represent cash that has been quietly leaving every month without being noticed. The subscriptions you have not used in over a year. The membership that made sense 3 years ago, small individually. Multiplied across every unexamined line item in a $140,000 income, the reclaimed total is never as small as it looks on a single line. Level 7. Budgeting at $200,000 and above. When the problem stops being money entirely. You take home $13,800 a month after taxes, 401k contributions already deducted. Mortgage with 9 years remaining, $3,100. Both cars paid off. Private school for 2 kids, $2,800 a month. Groceries for a family of 4, $980. Utilities in a larger home, $460. Insurance across all categories, $890. Housekeeper weekly, $480. Lawn and home maintenance averaged monthly, $320. Travel fund contribution, $600. That is $9,630. You have $4,170 left. Dining out regularly, $740 a month. Clothing, personal care, entertainment, $620. Charitable giving, $500. Miscellaneous, $380. That is another $2,240. You end most months with roughly $1,900 in surplus that sits in a savings account and keeps getting absorbed by home renovations, vacations, and quarterly tax bills that always feel slightly larger than expected. The problem at this income level is not budget management. It is goal absence. You have no defined target for what enough looks like. No written retirement number. No clear picture of what the money is supposed to eventually produce. You contribute to the 401k because it is automatic. You save what is left because it is responsible. But there is no destination attached to any of it. And without a destination, the surplus finds its own uses every single time. What works here is building the plan around a specific number, not retire comfortably, a number. If you want $12,000 a month in retirement starting at 62, you need approximately $3.6 million in invested assets at a 4% withdrawal rate. If you currently have $810,000 across all accounts and 9 years to go, you need to know that at your current savings rate, you will reach approximately $1.9 million. The gap is $1.7 million. That number, seen clearly on paper, changes every subsequent financial decision. Not because you suddenly earn more, because you finally know what you are building toward and can work backward from it with the same focus that built the income in the first place. The budget at $200,000 is not about discipline or tracking or cutting lattes. It is about having a number on the wall and treating it with the same seriousness you gave to every career decision that got you here.